Hello traders, and welcome to lesson 4 of this online forex course. My name is Emeka from ImoFX, and while watching this video, if you find anything confusing, kindly drop it down at the comment section and I'll be there to assist on your questions. So welcome to lesson 4, mastering technical analysis. So technical analysis is the primary method I use to anticipate the trend of the market, a price trend, to anticipate the price direction, because it's the study of the collective psychology of the market. So in a short term, what drives price up and down is emotion, the sentiment of the market. So in terms of fear, people tend to sell, and in terms of greed, people tend to buy. And people's emotion change based on their interpretation of the news. So many people think that they can be able to read the news and interpret the news in order to make decisions. Well, to me, it's a complete waste of time. Because number one, you can't predict the news. And even if you can, you cannot anticipate how the market is going to react to that news. So for instance, there was a time North Korea fired a missile over to Japan. Now, no one was expecting this, but when this happened, the market reacted to it immediately, in just a couple of seconds. So when they fired that missile over to Japan, everyone was thinking that Japanese yen is going to fall, because of the fear that Japan is going to be hit by the missile. And guess what? When that happened, the Japanese yen rose. But why did it rose? No one knows. So it depends on how the market interprets the event. And people who analyze the market will always say after the event that the yen rose because Japanese yen is a safe haven. And in times of crisis, people buy the Japanese yen. And to me, that's a complete nonsense. Wherever the market goes, whatever the direction the market goes, the analysts will always have to come out with something, in a way to explain what actually happened in the market. And for us as traders, we are not interested in why something happened. We are just interested in what's happening right now. How to capture trends in real time. And to do that, we have to look at technical analysis, reading chart patterns. Now, the important thing to understand is that technical analysis is not about predicting with certainty. You can't be sure what's going to happen, because in a short term, prices are random. But technical analysis is used to anticipate the probability of price movement. Technical analysis is about what is more likely to happen more often than not. And over a large sample of trade, we will be right more than we are wrong. And you can't be right all the time, and that's fine. So there are 3 axioms of understanding technical analysis. You understand why it works to generate high probability trades. The first thing we have to understand is that market discounts all known informations. So that's another reason why, to me, it's a waste of time trying to read and understand or predict the market based on what you read on the news. The US is going to increase the interest rate, and there is crisis in North Korea, and there is a European debt crisis. You understand? So there's no point trying to read and understand all these things. Because whatever you think you've read and know, everyone else has read that and know that too. And all known information is already priced into the market. So there's nothing you can read that will give you an edge over the market, because the market is the leading indicator of all these informations. So the market price is a reliable measure of collective human psychology. So like I said, market price is a leading indicator of all fundamental data. For example, economic and political news. So relying on fundamental news always causes you to react too late. And that's why the majority of people tend to buy at the end of the trend. So by the time they read, hey, the euro is going up, and they buy, the euro has already gone up. And by the time they read, hey, the euro is going down, and they sell, the euro has already gone down. So price gives us an immediate decision point, not the news. So the next axiom of technical analysis is that the price moves with the trend. When the price is in an uptrend, the probability is that the price tend to move higher. When the price is on the downtrend, the probability is that prices tend to move lower. So we always want to trade with the trend. Trading with the trend always and often gives us an edge over the market, and that's all we need. Now we understand that history repeats itself. Now in a short term, prices are often random in the nature, but at times it's not completely random. There are some repeatable patterns that you can recognize and exploit. So by studying chart patterns and indicators, you can anticipate the probability of the future price movement, by the virtue of the fact that certain price pattern often repeat itself. And that is the study of technical analysis. So once again, we are not trying to predict with certainty. We're not trying to be right 100% of the times. So technical analysis is just used to anticipate a high probability in the market. And as long as we have a slight edge over the market, that we are right more often than when we are wrong, even with just a slight amount, we will be very profitable at the end of the day. So technical analysis is the study of getting an edge over the market. And to do that, we'll use a combination of identifying trend, support and resistance, talking about the moving average, indicators, candlesticks, which is the price action, and other indicators. So let's begin with the lesson. Now, whatever charting software you are using, we are going to be using MT4, which is the most common charting platform in the market. I'm going to show you later how you can set up the chart, how you can set up your candlesticks, how you can set up the indicators. So the first thing on the chart is that you can select candlesticks pattern. So the prices will be reflected on this candlesticks pattern. So you can see there are two kinds of candlesticks pattern. You have the green candles and the red candles. So you have to select what kind of candle you are looking at. Now for my own strategy, I primarily trade on the 15 minutes candle. If you look at my screen, you call it the M15. So what this means is that each candle you are seeing on my screen here represents 15 minutes time frame. So the candle opens and closes within a 15 minutes. So every 15 minutes a new candle is formed. So these four candles combined represent an hour. If you look at it, so while trading on the 15 minutes candle, we also get a confirmation on the hourly candle. So when we click on H1, that's 1 hour candle. So in this case, each candle will represent 1 hour. So it doesn't matter whether there is a 15 minutes candle or whether there is 4-hour candle. Certain rules applies to all of them. Certain rules applies on how you can read the candlesticks pattern and what it means for the market. So again, when you look at the chart, there are two kinds of candle. So you got the green candles and the red candles. So whenever you see a candle that is green, it means a bullish candle. So now what does bullish mean? So bullish means that the candle closed above the opening price. So it opened at a certain price and it closed above that price. So in that time frame of 15 minutes or hourly, the market was bullish. It's going up, if you will say. So whenever you see the green candle, first thing is to look at the body. So this entire thing you're looking at here is called the body of the candle. So when you see a green candle, the base of the body is the opening price and the top of the body is the closing price. Now the tiny line above it is called the upper shadow and the tiny line below it is called the lower shadow. Some people call it wicks or tail, but I just call it the upper and the lower shadow. So the upper shadow tells you the highest price reached on the time frame and the lower shadow tells you the lowest price reached on the time frame. So from the top of the candle to the bottom of the candle is called the range. So again, this is just for general knowledge. You will not be using this for making analysis. Now the next one is the red candle. Whenever you see a red candle, it means a bearish candle, the selling candle. So this means that the price closed lower than it opened. So it means that price went down from the opening price. So whenever you see a red candle, the top of the body is the opening price and the bottom of the body is the closing price. So this is a kind of reverse and opposite of the green candle. So similarly, the upper shadow tells you the high of the candle and the lower shadow tells you the low of the candle. So when we head over to the chart, candle is just like people who comes in all shapes and sizes. Some are tall, some are short, some have big body. So when you look at all these candles, they are not the same. Everyone is unique in their own way. So what all these things tells you is the psychology behind the market, the emotions of different people at different time. Now, as you can see, there are many kinds of candlesticks pattern. And as they are different, many names are being given to them. We have something like bullish engulfing, we have the bearish engulfing, we have the morning stars, we have the shooting stars, we have the evening stars, a lot of names given to them. So for the purpose of making money and for the purpose of me showing you my strategy, so all we are going to be focused on in giving you my strategy is the pin bar pattern. We mean the pin bar candlestick. So this is one of the major patterns that I use in trading Forex. So it's not always good to overcomplicate things. So we just focus on one approach and make money consistently. So now we have two kinds of pin bar patterns. We have the bullish pin bar and we have the bearish pin bar. So the bullish pin bar pattern is the kind of pattern that where the body of the candle is relatively very small. So when you look at my screen, you can see all the candlesticks there. These four candlesticks are called the pin bar candle or the pin bar pattern. And if you see, they are all bullish pin bar. So when you look at my screen, you see that there are two kinds of bullish pin bar. We have a bullish pin bar that has a very tiny body and we have the one that is relatively small. So this pin bar that looks like a line means that market opens and closes at the same price. So one of the characteristics of a bullish pin bar is that it has a little or no upper shadow, just little or no upper shadow. So another characteristic of a bullish pin bar is that the lower shadow have to be very long. It has to be very long, more than the body. So what this means precisely is that the length of the lower shadow has to be 2/3 of the range of the candle. So remember the range. The range means the top of the candle and the low of the candle. The highest the candle has formed and the lowest price it has gone. So these are the characteristics to look out for in a valid bullish pin bar. It has to have all these characteristics to be valid bullish pin bar. So I look out for a valid bullish pin bar when I'm about to go long, when I'm about to buy, because the bullish pin bar is a valid bullish signal. And let me explain why I said that. So when you see a bullish pin bar, what it means is this. Now, when you see a bullish pin bar, it means that the price opened at a certain amount and then the bears pushed the price down to an extent where the bulls started pushing the price up, and the bulls pushed the price up to the entry point. So what this means is that the buyers are in control of the market now, because the bears, which are the sellers, they tried to push the market down, but the buyers pushed it up back right where it started. So it means that the buyers are in control. So this is a valid buy signal for you. It means that people are buying. There are more buyers in the market than the sellers. Now, another thing to look out for is the position of the bullish pin bar, the position where it appeared, the location where it applied. This is very important, because you cannot just see a bullish pin bar and buy. You have to also consider where it appeared. So the bullish pin bar should ideally appear at a level of support. I will still teach you about support and resistance in the lesson that will come. So just understand that it has to appear at a support level. And another thing to look out for is that it's not just to appear on a support level, it has to appear on a support level in an uptrend, in a clear uptrend. So an uptrend is the pattern where the market is going up, when the market is making an up movement, like it's moving up, and where the market is making a higher highs and higher lows. So now when you look at it, you see that the overall trend is up. Now, while making the uptrend, the market comes down temporarily and form a bullish pin bar at the support level. So when you see this, there is a high chance that the market will continue to go up, and that's the point you're going to buy. So a bullish pin bar has to appear at the support of an uptrend and not anywhere else. Now, looking at my screen, this is the real life example of what I mean by uptrend and the correct place that a bullish pin bar should appear. So look at my screen now and spot the bullish pin bar. So the one I just pointed out is the bullish pin bar. So now notice that the overall trend now is up. So when you look at the chart, another thing to also observe is that the market is on a clear uptrend. And I'll also teach you how to use a moving average to identify the change of trend, because when you see I'm on my screen now, you'll find out that the market was in a slight downtrend and it reversed and turned to an uptrend. So moving on to the next one, let's talk about the bearish pin bar. Now the opposite of the bullish pin bar is the bearish pin bar. So bearish pin bar is the bearish reversal pattern, and I look for this pattern when I'm about to go short, when I'm about to sell the market, when I'm expecting the price to go down. So again, this is a specific candlestick pattern where the body of the candle is relatively small. So when you look at it, you see that it's just a reverse of what we saw on the bullish pin bar. So again, on the bearish pin bar, you notice that there is little or no lower shadow. But when you look at the upper shadow, you notice that it is really long, and it's 2/3 of the range of the candle, the total range of the candle. So bearish pin bar indicates that the price is going to go down. And again, listen, it has to appear on the right context, at the right position, for it to be a valid bearish pin bar. So now, where should it appear for it to be a valid bearish pin bar? Now, it has to appear at the resistance of a clear downtrend. And again, I'll show you a clear practical and a real life example of what a downtrend means. So right there on my screen, you can see the chart. This is a real life chart example of what a bearish pin bar should look like. And when you see on this chart, you notice that the market is on a very clear downtrend. Again, I'll teach you how to use the moving average to spot a clear downtrend, not just a downtrend, but also an uptrend. So now look at the chart and spot the bearish pin bar. So the one I just circled, the one I just pointed out is the bearish pin bar. So now for the purpose of making money, this is all you need. So now let's talk about identifying trend. How to identify a trend the moment you look at the chart. Because if you can grow to an extent where you can look at the chart and identify the trend without the help of any indicator, I can tell you that you're on a halfway on the road of becoming a successful professional trader. So because when the price is on an uptrend or downtrend, there is a high possibility or probability that the market will continue to go on the trend. So now there are three phases of the market. Every market, there are three phases of the market. The first one is the uptrend. Now, when the market is on an uptrend, there is a high probability that the price will continue to go higher. So in general, we always want to buy on a clear uptrend. So why on the uptrend, the ideal time to buy is when the market makes a temporary dip on the market, when it makes a higher low, when the market pulls back a bit before continuing to go up. So next we have the downtrend. Now remember, the downtrend is the opposite of the uptrend. So when the market is on a downtrend, it means that there is a high probability that the price will keep moving lower. So downtrend is a market situation where the price keep making a lower highs and lower low. So the areas I circled is called the lower highs, and the areas I'm circling now is called the lower lows. So again, the best time to enter a short position is when the market makes a temporary rally, when it goes a little bit high. So now when you look at my screen, the place I'm pointing, you see a bearish pin bar. Now the next price trend pattern we are going to be talking about is the consolidation pattern. So now in a consolidation pattern, price moves sideways between a support level and a resistance level. So this is a situation where prices cannot go beyond a certain level, and it's finally difficult to go beyond a certain level, and this happens between a specific given time. So whenever the market is on a consolidation period, it means that the market is confused on the direction to go. It means that there is almost an equal amount of buyers and sellers at the same time in the market, battling on who is going to win the race, because anytime in the market is a battle between the bears and the bulls. So they are always fighting, and whenever you see a consolidation, it means that their strength is almost equal. There is no more buyers than the sellers, and there is no more sellers than the buyers. So at the support level, it means that this is a price that a lot of people want to buy because they psychologically felt that this is a cheap price to buy the product or the actual commodity. So when the price goes up to the resistance, it means that this is the point where they felt like they are going to sell, that this is the highest point it can go. So by so doing this, the market is creating like a kind of resistance on the price, saying that this price cannot go beyond this place. This is where we have to sell. And this keep going on and on and on in the market, and it creates a range. It creates a consolidation in the market. So now let's talk in depth about the support level. So support level is the price level at which the demand is thought to be strong enough to prevent the price from declining further. So in this case, you can see the level of support here that I'm pointing out. So if you can see that this level here prevents the price from declining further, in the moment it touches that price, it goes up again. So now when the price hits a support line, that is a support level, and fails to break it, it creates another bullish momentum that will push the price up again. And then when the price breaks the support line, it creates a bearish momentum that will now push the price down in a massive way. Now this is not my style, but some people do trend this range. Some people do trend when there is a consolidation in the market. When the price hits the support, they buy, and then they sell at a resistance, and then they sell again at the resistance and buy back at the support level. Now this is a very effective trading strategy, but this is not what I'm going to be teaching you now, and this is not one of my major strategies. So this is not one of the things I will be teaching you here today. And again, there are other strategies. There are traders who tend to sell at the break of a support level. We call this the breakout strategy. And again, this is not one of my strategies. This is not, I do trade this. I've tried this several times. But this is not what I'll be teaching you here in this channel. So now the opposite of support is resistance. Now resistance is the price level at which selling is thought to be strong enough to prevent the price from rising further. And again, when the price fails to break the resistance level, it creates a bearish momentum. Now there's another concept that I use a lot while trading currencies that I want you to understand. It's called the testing of support and resistance. So when I see that the price is testing a support, what does it mean? It means that the price is going to the support and is bouncing off the support. And the support is preventing the price from going any lower. That's what it means by testing. So a good test is when you see the body of the candle remaining above the support level, and then the lower shadow goes below the support level. Then you can consider this as a strong test. So in this case, you can see the body of the candle remains above the support, and then the lower shadow cuts below the support level. Then you know this is a very strong test. Now what does this mean? Now this means that the price opened somewhere there, and then initially the price went down below the support level. Just like it's like breaking below the support level, but it could not remain below the support level. So at that point, buyers came in and pushed the price above the support level. And then by so doing, the price eventually closed above the support level. So this is a very valid bullish pattern. So this just tells you that the sellers were not able to keep the price below the support level. So at that point, buyers came in and brought the price above the support level. Now, this one I circled is not a very good test. Why? Because in this case, the body of the candle closed below the support level. So the price opened above the support level and closes below the support level. So what this means is that the sellers were able to successfully sustain the price below the support level. Now similarly, when you look below the screen, you can see that it's just a reverse of what I showed you on the support level. Now the price is testing the resistance level on this case. And this brings us to the end of today's lesson, and if you have any question at all, kindly drop it down at the comment section and I will be glad to assist on your questions. Thank you and bye for now.